Let's show you my $167,000 stock market portfolio. We're an investing stock market finance channel, so I figured why not share some of my finances with you and just to see what I'm doing in the market so you can get an idea of what a silly 24-year-old would be doing with their money. So right off the bat, what makes up my $167,000 portfolio is really just 6 positions here. 1, 2, 3, 4, 5, 6. Yes. Starting with AMD, I have about $71,000 in AMD, with 22.9 of that being gains. And I really invested in AMD because I saw they had dropped so much to silly valuations where the forward PE was like 20, and it just didn't make sense that AI was picking up and there's all these growth factors for them. I truly like AMD products. I built my brother's gaming computer with an AMD CPU, and it seems to be the value product that you can get. So you're getting the performance while paying a cheaper price while getting great performance. So who wouldn't want that? And that's what really interested me into, the stock overall. But then when you start learning about the data center and everything, it gets really interesting. Go super deep into my investment thesis for each and every position that I have. But let me just run through each position and what their gains or losses might be. So the next position here is Google. I have a Class A share and a Class B and a Class C share. Now, I really didn't even know that Class A shares existed. So I bought the Class C shares years ago, and these have just been sitting inside like a Roth IRA. And overall, I have about $35,000 of Google stock, with that being $9.4 thousand of gains here. And Google has just been a great runner for us, and I love Google. I still think Google today is undervalued, but more on that later. Amazon. This one is a smaller position. I have about $7,000 of Amazon stock, with 1.3K of that being gains. And I really loved Amazon. I've been holding it forever. I've recently added to it just a little bit because they've dropped slightly, but overall, Amazon's one of those companies that you can't go wrong with. Of course, more on that later. Crocs. This is one that is actually down for us today. We are down 1.5K on this stock. We've put in about $19.3 thousand. Today, our position is worth 17.8K. We're going to talk about what's happening with Crocs, what the hell happened, and why are we still in it? Next, Nvidia. Nvidia, I have about $2.2 thousand. It's a really small position, extremely small, maybe like 1% of the portfolio. And this is 1.8 of that is gains. We have an 82% return on Nvidia. This was really really funny because I bought this company because I've held it in the past, and then my dad was like, just buy it and see what happens, and we'll like have this running bet. And he seems to be right because this has outperformed any other position I've had. So, which is funny, and I'm holding it for keepsake. Lastly, PayPal. I put about $28,000 into this company. I'm up $3.6 thousand. Today's position is worth $32,000, up about 12% on the company. Now, this is an undervalued play that I will get into the metrics later. And if you guys haven't already, make sure that you subscribe to see more investing content like this and portfolio reveals. And I also analyzed all of my stocks inside of Excel. I bring it out of my brokerages and analyze it myself just to get a view that I'd like. So if you look at just my stock allocation, everything I have in individual equities or stocks, I have about 43% of the portfolio in AMD, 19% in PayPal, another 21% in Google, 11% in Crocs, 4% in Amazon, and 2% in Nvidia. And if you're wondering why an AMD is such a large position, it was really grown into that. And I have to really evaluate whether I want to, keep it, cut it, buy more, which we're going to get into. So we have about $160-ish thousand here in this tree map. We can see that AMD is the biggest, followed by Google, PayPal, and Crocs. Of the percentage winners, we see that AMD is not the best, but not the worst. Nvidia has really knocked it out of the park, but again, it's a 2% position, making it very small. The other positions are pretty standard. These have been pretty good gainers for us throughout the years. And Crocs, that one's been a recent downward move. I'm okay with that being down, which is okay. We'll get into that. Now, AMD being one of my biggest positions, it's really critical for me to interrogate and question and challenge all of the valuations here. 90 PE today. It's extremely high. It looks extremely high. But if you look on a forward basis, it's probably 40s. So it's not the worst, but not the best, given that they need growth to come in AI sectors. The PE ratio is actually pretty low throughout the years. AMD historically has been a sky high valuated company that a 90 PE doesn't look that bad in comparison to where they are in the past. These growth companies, it's very difficult. Like once they start catching fire, it just keeps going and going. And it's pretty insane to see what a company can do. In the past couple of months, this company has almost doubled. It's doubled actually. And that's remarkable. Looking at free cash flows, price of free cash flow, it's still a smaller valuation in comparison to where it was in 2023, 2024. Now, we really hope the AMD can increase their free cash flows and earnings through selling this new chip that is supposed to compete with NVIDIA. Hopefully, there's not too many tensions with China. We have to wait and see. Like, obviously, there's tariff risk as well. But now as a shareholder, I really have to see if I want to continue buying the stock, holding it, or cutting some of the shares. And I'm going to run it through a valuation calculator here. It seems like we would need a 20% CAGR growth for free cash flow to make this kind of worth it. And if you value these price of free cash flows at like 55, 10% return, shares growing at 5%, you're about at fair valuation. So you would either need a 25% free cash flow growth in order to be undervalued today. But I'm not even going to say like 25% because that's pretty optimistic. I'm going to go 20. And we want a 10% return. I'm going to say price free cash flow about 55 because NVIDIA today trades at like a 60. So we're going to go, a little discounted to NVIDIA because they have dominant market share. And can we really demand that high of a premium? I think that 20 makes sense here. I think today AMD is fair valued. I'm not adding more to this position. Maybe a couple months ago when it was $80 a share, it would make a lot of sense to. I'm just letting it ride, putting my stock in there to just watch and see what happens. I do debate on taking some of the shares out to reallocate into other positions, but you don't want to cut your flowers to water your weeds, right? This is one of the flowers, and I think we should let it grow. This is a quality company with Lisa Su running behind it. She is the top CEOs of the entire universe. With great leadership, it makes so much sense to keep my money in AMD here. I'm a firm believer that this AI adoption over the next couple of years will prove to be correct, and with AI and capital expenditures coming from Meta, Amazon, Google, this all is adding to the pie that AMD can steal and take the market share that they are able to obtain. So overall, I'm pretty bullish on AMD, but keeping my position where it is now, though I do believe it is fair valued. Now, next, with one of the biggest positions being Google, that is one that I have been adding to very recently, very aggressively. And look at the valuation. It is a 22 PE. Historically, this company trades around 20, 23, 25, 27 at the highs. And this is a discount in comparison to where it was in the past. And realistically, you have to ask yourself, where have earnings gone? Straight and up to the right. Now, that is something that we absolutely love to see. That's like, if you were to buy this company in 2021, you have almost, I guess, like 50% increased your net income here. So Google's in a way better spot than it is in the past today. I am a firm believer that Google will come out on top. There's so much hate around Google of what if they get broken up by the government, AI is going to take over Google search. But realistically, Gemini is actually pretty good. I've been using Gemini trying to compete against, like ChatGPT. And obviously, I think ChatGPT comes out on top, but Gemini just has so many like unlimited queries that you can run. There's not really a limit that you have on there. There's an article that came out that Apple is trying to adopt Gemini to be the backing of the AI. Overall, Google's buying back shares at an insane clip here, like 1 to 2% every single year. This is a free cash flow beast. Like they're earning, what is it, $70 billion of free cash flow. It's insane. I personally believe that if you were to buy Google today and you put in these assumptions of 10% free cash flow growth at a 30% price to free cash flow ratio, let's go 35, 10% returns. You're looking at pretty much fair value today. It's not bad. I think this is one of the companies that are going to be around for the next couple of decades. And if they're actually able to capitalize on AI and take that over, I don't want to say like buzzwords here, but if they're actually able to capitalize on, the search, focus on cloud, and also focus on these other opportunities they have, like Waymo, that is going to be one of the biggest like things that are going to be the changers for Google's profitability in the future. I think it's always exciting to see where Google is in comparison to all of the other players, though Waymo doesn't have such a big weighting in the overall scheme of profitability. I think Waymo is one of the interesting things that is actually better than Tesla's robotaxi because they use lidar instead of radar. So you're using like objects like radar being sent back and forth from objects versus cameras. So like shadows can get in the way of autonomous driving. So who knows? Maybe lidar is the future and there's an untapped market for Waymo to discover. Next is PayPal. I'm pretty deep in PayPal. Now, I have seen this company drop from almost $300 all the way down to 70, as low as 60s and 50s. I've been buying along the past couple of years because the company has just been increasing revenue year after year. Free cash flows have been somewhat steady, but they're buying back shares like a beast. And if you look at their free cash flow yield, that's 7% free cash flow yield. That's pretty good. And overall, price earnings, this company has been trading at record lows in the past couple of years. It's just more of like, do people use PayPal, Venmo, Braintree, all of these things for checkout? I would say most people still do, even though I've kind of transitioned to Zelle myself because it's just instant and it gets there like super quickly. That PayPal I use for like friends and strangers. I wouldn't ever use Zelle for a stranger. Maybe sometimes, but you don't have that protection that you do with Zelle. Looking at, valuation back here, I think they can grow free cash flows at 10%, free cash flow ratio here of 13. We have an undervaluation in PayPal of about 10%, and I'm okay with that. I'm okay with my position, though it's not like super huge. I'm okay with letting this ride out. It's a value play. They're buying back shares. Hopefully Alex Chriss can turn around the company, the CEO of the company, and he can put more efforts into branded checkout and Braintree to grow the business overall. Now, Crocs being the next largest position here, Crocs has been down about 8%, but I truly believe that this company isn't that bad. Before, Crocs used to trade at a 6 PE and it used to be super undervalued, but then there was this accounting rule where they wrote off the loss of Hey Dudes, and that just shot their price to earnings ratio way higher because it looks like now they're earning less, though that is like true, but it's on an like accounting basis where they are writing off the loss and it's taking a loss. But overall, we've known the company Hey Dude hasn't been working out in the past couple of years. The company is still increasing revenues at a slow clip, increasing cash flows, buying back these shares at like, what is it, 7%? And their free cash flow yield is 15%. That is insane. The margins on this company are insanely high. They're like 60% for a product shoe company. Realistically, it's just clogs, and the material that it takes to build it isn't too costly. Looking at the Crocs itself as a brand, I truly kind of like the brand. I think that kids are going to have to wear Crocs because parents, they just want to have an easy access, like throw on shoes, get out of the house right away, super easy, super simple. And there's all this collaboration with Animal Crossing, Monsters Inc., NFL. Look at this. Like, we're coming out with NFL branded shoes. They got the season picking up, like the Chiefs, the Eagles, Buffalo Bills, Bengals. A bunch of kids may be into sports, especially adults too. Like, the season's picking up. I expect this to do decently well. Though I don't know who's actually wearing those. Maybe if you're super spirited, I wouldn't wear them if I'm, but maybe around the house. But a lot of people think this is ugly. Crocs are ugly. And I personally think this has a moat. Like, people don't just buy, like, people buy Crocs. They're like, oh, I'm going to go get Crocs, or go get my Crocs, or I'm just going to wear Crocs. Like, oh, I'm not gonna wear like sandals. I'm not gonna wear like clogs. I'm gonna wear Crocs, and I'm gonna buy the gibbets that go onto the Crocs, and I think they're cute, and I'm gonna customize my own. Looking at Hey Dude, this company has been struggling to increase sales, and really after the Sydney Sweeney campaign, everything's just kind of gone down, and they had like the Travis guy from the college football that's been doing like that did okay, is sold out. But overall, this company has been struggling to increase, this brand awareness and profits back to the company. It hasn't been growing at the clip that investors want it to. And I truly think that there needs to be a campaign between Hey Dude and Crocs. We need to get like pop culture back onto this. Like, you see what Cat's Eye did with Gap? We need to do that for Crocs and bring that back. We need the marketing team to step up and pull over the most influential people that are talented and diverse to show what Crocs is truly about. And I think if they have that, who knows? It'll be a huge one. But overall, I think that Crocs are going to do okay with international expansion being 50% of, in Asia and America. And this tariff risk, I'm not too worried about it. I think hopefully the US and China can come to some kind of, middle ground, and there won't be that much of a tariff. But the margins are so well that Crocs could technically absorb this tariff and be okay still. So I'm not too worried about that. I'm going to keep my money in Crocs. I do think that there is a future for Crocs, and there's the cyclicality of this stock that there's going to be downturns and upturns, but we're going to ride this wave all the way until we get a nice return. Amazon here, a smaller position of about $6,997 here. We're up about 19%. This company here has really shown itself to grow revenues double digits, low double digits though. Free cash flows have been slowing down, though they have been increasing CapEx a lot lately. This CapEx number has been going up, which is why free cash flows are going down. We need to make sure that capital expenditures are going to pay off in the future. That's everything AI, everything cloud-based. And overall, I think Amazon is one of those quality companies that you kind of just hold forever. PE, this is a record low PE for the company. Like, it wouldn't bother me to buy more today because my position isn't that large enough that I'd be okay with buying Amazon today. Though I wish I bought a lot more in the past, you kind of don't have the money way back then, and now you do. So does it make more sense? But overall, like, I like Amazon, but I just like Google more. So all of my money has been funneling into Google. On a price to free cash flow basis here, it's still record lows. It's not even that bad, like, compared to where it was before. But on a, just looking at it, price to free cash flows of 176, it's pretty bad. So it's not bad, but it is bad. Amazon is just one of those companies that have a extremely wide moat, and buying the company, you can't really go wrong. But this is one that I would kind of just maybe put on a hold if you have a larger position, though my position isn't that big, which is why I've been adding a little bit. But if you have a larger position, I don't know. If I did, I would kind of hold off and just kind of funnel position money into Google instead. Now, Nvidia, I have about $4,000 in Nvidia, and this is really not that much to move the needle that I'm just willing to watch this and see where it goes. I'm already up 80% on it, and Nvidia has been crushing every single quarter. This quarter, they actually crushed again, but they're down 3%. I'm okay with that. It's not that big of a position. I just love tracking it to see where it compares against AMD and looking at their market share, how much the market share they have in comparison to AMD as well, given that AMD is the largest position for me. Well, that is my $167,000 stock market portfolio, with $37,000 of that being gains. If you guys like my stock market portfolio reveals and want to see everything that I'm doing with my portfolio, make sure that you subscribe here for more of that content. Thank you guys so much for watching, and peace out.